Hey, what's up guys? Welcome back to the channel. So I recently created a new series called Stocks That My Viewers Are Buying. And the reason I did it is because the stock market continues to trade near record highs, and I'm finding it more and more difficult to find really good, solid companies that trade at attractive prices. So I thought it would be fun to kind of include you guys and ask you guys what stocks you're either buying or that are kind of high up on your watch list, either because you think that they're on sale or you just think that they have an attractive price just kind of in the general sense for whatever reasons that you have. But I think this is kind of a fun way of interacting with you guys, and the first episode got a lot of positive feedback and you asked me to keep the series going. So I created a new playlist where I'll be putting all the episodes into, and I'll have that linked for you down in the description and at the end of this video on a clickable card. But the way we'll be doing this is we'll be choosing at least 3 different stocks at least once a month to do a new episode. And the way I'll be choosing the stocks is based on the comments that you guys leave. If a comment gets a lot of likes or if a lot of different people mention the same stock, then I'll probably cover that stock in the video. So if you want to participate, make sure you leave a comment down below. Let me know which stock you're either buying or you think is attractive right now, and give me a short reason why, and it might get covered in the next episode. But let's go ahead and kick things off here with one of the comments that got the most likes on the video. And this is actually a very nice comment from Hector Martinez. It got 10 likes on it. And he says, "What? Nobody is buying Colgate, Clorox, or Cisco? I like the video as always. Good to see what other people are buying and their opinions. Thanks for covering the topic. Keep up the good work." Okay, thank you, Hector. I really appreciate the nice words there. He mentioned a few different stocks, so we'll just take the first one that he mentions, and that's going to be Colgate. Ticker symbol is CL. Let's go ahead and jump right into this one. Okay, now you've probably heard of Colgate-Palmolive, as the name alone gives you a pretty good idea of what they sell. Obviously including Colgate toothpaste, which makes them the global market leader with 42% share of the toothpaste market, but also 32% share of the toothbrush market as well. But they are much larger than that, as they also own brands like Palmolive detergents, Ajax bleach powders and liquids, Soft soaps, and even Hill's Science Diet Pet Food, just to name a few. So this is really one of the safest and kind of most dominant consumer staple stocks in the world, in the sense that they're very unlikely to go out of business anytime soon, given how heavily the entire world relies on some of their products even through recessions. But one of the drawbacks of already being so large is that the growth tends to be pretty limited. So if you're a little bit more of a growth oriented investor like myself, you'll probably want to look elsewhere, as their revenue growth has practically been flat in recent years and is only expected to finally climb a little next year by about 3%. This is pretty surprising to me given how strong the US economy is right now, but I suppose that may be getting offset by weakness in the global economy, which Colgate is heavily exposed to. In fact, that may also be the cause of extremely low profit growth, as their EPS is only expected to climb by 1% on average over the next 5 years. And it appears that this low growth has led to a very choppy stock over the last 5 years, as they've only climbed by less than 3% over that time, which is pretty bad. And even despite the very slow moving share price, their valuation is still 4% higher than the sector on a forward PE basis, or the sector median I should say, at a time when the stock market is at all-time highs. So some people wouldn't really consider this that much of a value stock either, although I would argue that they deserve to trade for a little bit of a premium to the sector. But anyway, you might be wondering who is going to really be interested in investing in Colgate. Well, apart from offering some stable diversification to your portfolio, which mine, for example, is very tech heavy with a little bit higher amounts of risk, I think the biggest reason why people would invest in Colgate is likely due to the very attractive dividend that yields over 2.4% with a massive 56 years of consecutive growth. It's not likely to grow at any high rates in the future, given the payout ratio of over 60%, coupled with the low growth rate of less than 4%, but that massive growth history at least tells you that management is very committed to continue paying out that money to you, even through recessions, at times when most other companies are forced to cut their dividends because their businesses take huge hits that is lessened a great deal to something like Colgate, again, given the fact that we tend to still buy many of their products even during difficult economic times. So for that reason, I can understand why some people would want to hold this stock, given all of the fears surrounding a looming recession happening sometime soon. There's a lot of talk obviously going around about that. But that doesn't mean that this stock isn't going to fall during a recession. And I actually think that that would probably be the best time to pick up a stock like this because this is a very slow moving stock. So during a recession, you could theoretically get one of the lowest prices for a stock like this, and that would give you a lot more upside potential, which is important for a very slow moving stock like this. It would also give you a very high dividend yield because the price would be lower and the dividend is already very attractive. And because it's been grown for so many years, it's a very stable dividend. So I think, again, during a recession, that seems like the best time to pick up a stock like this. But at current prices, I think I'd rather pay a premium for a company that is actually growing, whereas Colgate is not really seeing too much growth. So it's not really a stock for me personally, but I can understand why some people would want it, especially for that fairly secure source of income coming from that dividend. Okay, now Hector does also mention here Cisco, and I'm not trying to favor Hector, but I noticed that a lot of other people also mention Cisco, including comments from people like La Discordia, AU, Raymond, Ryan, and Andrew, who says, cool video concept, you should definitely do another. Cisco looks undervalued at the moment. They've been beating EPS estimates the past several quarters, but Wall Street has punished them due to macroeconomic uncertainty. Okay, so this one does look pretty interesting. Let's go ahead and take a look at Cisco. Okay, well, if you've never heard of Cisco, they're mostly an internet and information technology company that sells a number of products, especially switches and routers, which are used for accessing networks, and Cisco happens to be the market leaders in that space with over 50% market share. But they're also heavily involved in growing markets for the future, like the data center, the Internet of Things, of course, like just other networking markets in general, but also even security. In fact, by offering a combination of network hardware like switches and routers, along with services like cybersecurity, Cisco is able to market to companies and say, look, if you go with us, you get the complete package and we can handle all of your computer infrastructure and solve all of your networking needs for your entire business. And because they're already so dominant, they can continue to sell new upgrades and features to their already large customer base. However, the networking market has changed a lot in recent years with growth in cloud services from companies like Amazon, Microsoft, and Google, and it's been argued that Cisco hasn't really adapted fast enough to work well with these new services, whereas newcomer competitors like Arista have gone all in on the changing trend, and that, coupled with macroeconomic issues like a broad-based slowdown in tech spending according to MarketWatch, and weak data center sales caused by trade disputes and other tensions according to Data Center Knowledge, has led to Cisco stock crashing by about 25% from their 52-week high before recovering a little, but still being down about 15% from those highs, despite the stock market continuing to rally and break new records. Granted, they are still up by over 77% in the past 5 years, but partly thanks to the recent struggles, their forward PE ratio is still over 50% cheaper than the sector, and a cheap valuation is not the only thing that you get with Cisco, as they also pay out a very attractive dividend that yields close to 3% with a double-digit 5-year growth rate of over 13% to go right along with it. But because of the issues mentioned earlier, their business can be a little volatile at times, given that around 40% of their sales actually come from outside the United States, and that international weakness may be the cause of sales being expected to drop by around 2% in 2020 before climbing again in fiscal 2021 by around 3%. That little rebound, though, is likely also due to Cisco's new willingness to adapt to the changing markets. Take, for example, the future of 5G, which Cisco is aiming to take full advantage of with their first ever custom networking chip called Silicon One that will increase the power of their switches and routers, which, by the way, they used to depend on third parties for, but the new chip is expected to be much more powerful and offer new capabilities that can be used by companies and their networks, including for 5G purposes. They also made a recent acquisition of Exablaze, which is an ultra-low latency networking specialist, and their expertise is expected to help Cisco work with faster 5G networks for obvious reasons, but it also is useful in financial markets where low latency speeds are required for transactions and high frequency trades. In other words, it does look like Cisco is willing to adapt to the changing trends of the market, and when you couple that with the low valuation and the very attractive dividend, I think the stock does start to make some sense here from a long-term perspective. However, I've always had a difficult time fully understanding all of Cisco's business and their competitors and their markets. And for that reason, it's not really a stock for me because it kind of goes against my investing principles. I really need to fully understand a company's business before I'm willing to invest in them. And I also have some exposure to similar markets through companies like Amazon, Microsoft, and of course AT&T. Now, they're not exactly the same thing as Cisco, but I do have some exposure to kind of similar areas with those stocks, especially in markets like the data center and 5G. So for me, it's just not a stock that I really need at this moment. So I probably won't be picking this one up unless I do more research on them. But it's another stock that I can understand why some people would want to be buying it at their current price. Okay, and last but not least, we have this stock that I think the most people requested or kind of mentioned, and that is iRobot, ticker symbol IRBT. Might be because I think Jeremy might own the stock. I know he did at least at one point. I'm not sure if he still owns it. You guys can let me know down in the comment section, but don't quote me on that. I'm not sure if he still owns it. But iRobot, like at least 7 different people mentioned this stock, and I didn't even go through every single comment, but I at least counted at least 7 different people that mentioned it. And some of those people were the Mongolian Way, who says Macy's and iRobot buy now and thank me later. Also David, Eric, Maximilian, who says check out iRobot, great video. Ken's, Spyridon, and finally Vincent, who says only 2 stocks now in my portfolio, Canada Goose and iRobot. iRobot is more like an undervalued stock for me. The competition and the effect of a trade war is real, but given its solid performance for the past decade and perfect balance sheets with 0 debt, I believe that it's oversold now and will bounce back the moment that a trade deal is signed. Okay, so this looks like another interesting one, so let's go ahead and take a look and we'll see what we find. Now, I'm sure that you guys have heard of iRobot before, but in case you haven't, they're mostly famous for the robotic vacuum cleaners that basically move around your house autonomously, vacuuming everywhere they go. But they also sell a number of other products too, including mops, mowers, and they even mentioned a robotic butler at CES, although it's not expected to launch until 2025. But by far their best-selling products are those robotic vacuums, and hey, that's not a bad market to dominate, given that I fully expect most households in the future, especially middle class and higher, to have at least one robotic vacuum cleaner in the home, and that's a market that iRobot controlled more than 50% of back in 2018 according to Statista. However, the problem for iRobot is that they continue to face more and more competition, especially from China, who tends to undercut their prices. Back in 2016, they had 64% market share, but that dropped to 63% in 2017 and then plummeted all the way down to just 54% the year after. Again, that's still very dominant, but it's been dropping. And as you can see on this chart, the number of serious competitors grew dramatically that year. And again, many of these are putting a lot of pricing pressure on iRobot. Digging through Amazon, I found a number of robotic vacuums with pretty good ratings that sell for around $200 or less. And if you're willing to go with less rated options, they can even drop in price to less than $100. For context, that's about half the price of the cheapest iRobot Roomba that I saw on Amazon, which was already $100 off on sale. Now, don't get me wrong, I'm not saying that these options are better than iRobots. I think that this is a very obvious case of you get what you pay for, and I think iRobot will likely remain the biggest player thanks to their higher quality and somewhat of a brand recognition status as well. But this added pressure from competition is taking a toll on their business nonetheless, as their sales growth has dramatically weakened over the years, dropping from 34% in 2017 to 24% in 2018 to 10% expected in 2019, and then stabilize at around 10% again in 2020. Granted, a lot of that can likely be attributed to the trade war with China along with global weakness, but it's still a pretty dramatic drop, and that coupled with the tariff issues have been hurting their profitability as well, as their net income for the past 12 months was only around $90 million, which is only slightly higher than the $87 million that they saw in all of 2018. In fact, things have gotten so bad that Yahoo Finance expects their EPS to drop by 13% in 2019 and then crash by another 68% in 2020, although they do still give them a positive 5-year growth rate of 18%. So maybe they're thinking that a trade deal with China will dramatically help them in the coming years, which I do think will likely happen. But I also think that this is a sign of higher marketing and promotional costs as they try to compete with cheaper alternatives. And the result of all of this uncertainty and pessimism has caused the stock to get destroyed over the past year, as they are down close to 60% from their 52-week high, although they are still technically up by over 70% in the past 5 years. Now, the commenter did mention the balance sheet. The balance sheet does look really solid to me overall, but I do want to mention the valuation, because even despite the crash in stock price, the shrinking profitability has left them with a really high forward P ratio of over 64, which is up from just 17 trailing according to Yahoo Finance. I'm a little confused though as to why they have it listed so high, given that Guru Focus has it much lower at 42, and then Seeking Alpha drops it all the way down to just 20, which is only 6% higher than the sector. So it doesn't look that bad from that perspective. And then Seeking Alpha also gives them an adjusted PEG ratio that is over 40% cheaper as well. And anyway, that's just all kind of confusing to me, because Yahoo Finance is usually the most accurate website, but this may be an indication of different analysts feeling, drastically different about their future projections for the company, and that's not exactly a good sign. So at the end of the day, I just really feel like there's a lot of uncertainty that is surrounding iRobot, and on one hand, I do think that a lot of that is being reflected in the stock price, but on the other, I still just kind of feel like this is a high risk, high reward kind of speculative kind of tech stock. And that's just not really a stock that I want to be adding to my portfolio at this time, because I am already so tech heavy with most of my stocks. Don't get me wrong, I do think that they'll continue to dominate their market, especially in kind of the higher priced, higher quality part of their market. And if a trade deal does get done with China, or just kind of gets finalized with China, then I do think that this could potentially be a high flyer once again. But on the negative side, I'm just not really sure what makes iRobot so special. Now, I may just be speaking out of ignorance here, but when looking at like a vacuum that just kind of moves around your house on its own, not really sure why competitors can't just build those themselves. And obviously they are, and obviously that is hurting iRobot. Again, at lower quality, but also at lower price points. So when I look at that market, I'm just not really seeing a very secure market. I see a market that I think is pretty easy to penetrate, and I don't think it would be that hard to kind of build these machines more and more so in the future. Now, if iRobot was to advance further into other areas of robotics, then okay, yeah, I might want to take a closer look at them and see what kind of proprietary technologies they have over the competition. But as it stands right now, it just seems a little too speculative to me, and it's just not really a stock that I'm interested in that much, for reasons that we mentioned earlier in the video. So out of the 3 stocks in today's video, I think that iRobot is probably the riskiest, but may also have the highest upside potential because it's been beaten down by so much. Then I think that Colgate is probably the lowest risk, but also kind of like least upside potential, although they do have a very nice dividend. And then Cisco is probably somewhere in the middle. So if I had to choose one of these 3 stocks to invest in right now, I think I would probably go with Cisco, because they do have a low valuation and they do have a very attractive dividend. And I kind of like their business more than at least iRobot. And then after that, it would probably be Colgate, because they have a more stable business. They do offer a little bit of diversity, and they have a very nice dividend. And then last, it would probably be iRobot. So anyway, these are just my opinions. Don't hate me. I'm just trying to be honest with you guys. I could tell you guys, hey, all these stocks are great and I would love to buy all of them, but I'm just trying to be honest with you guys and give you my honest feedback. So anyway, I probably won't be buying any of these stocks anytime soon, but let me know what you guys think down in the comment section. And again, if you want to participate, make sure you list your stock down there as well that you're either buying or is high up on your watch list. And if you enjoyed the video, make sure you hit the like button, as it really helps support the channel. But thanks again for all the support. I'll catch you guys in the next one. Take care. Bye-bye.